Good day to all distinguished panel members and fellow participants joining from different parts of the world. It is a privilege to be present today and share our research with you. Firstly, I would want to crisis. Our research shows it's also an economic one, and the banking sector is one on the front line. My name is Ian Gangata from the University of Johannesburg, and I'm honored to be presenting alongside Professor Oliver Takawira. Our study is the relationships between climate change, macroeconomic indicators, and bank performance in South Africa. It tries to examine how rising temperatures and erratic rainfall are already shaping the resilience and profitability of South Africa's banks. Today, I'll take you through the data, the findings, and what they mean for the future stability of the financial system. So my introduction slide, I'll first by defining what climate change is. So climate change refers to a long-term shift in temperatures and weather patterns, primarily caused by human activities, and especially the burning of fossil fuels like coal, oil, and gas. These activities increase the concentration of greenhouse gases, such as carbon dioxide, methane, and nitrous oxide in the atmosphere. So climate change is a systemic financial risk, especially in developing economies like South Africa. Climate risk is now treated as a financial risk globally. And the main emphasis I had on my research was on the banking sector. And my reason was the banking sector plays a very important role in the domestic economy through mobilizing capital and allocating it to productive sectors of the economy. So banks must factor both physical and transition climate risk in their operations. Moving on to the next slide, I'll be going on the problem statement. So the problem statement states the climate change poses a serious threat to South Africa's banking sector, with the World Bank projecting temperature increases of up to 4.2 degrees Celsius by 2090 and reduced rainfall, which could destabilize the economy. The second one is the environmental changes increase banks' exposure to physical and credit risk, especially in climate-sensitive sectors, leading to greater defaults and operational disruptions. The third one is the transitional risk from the shift to low carbon economy may also impact banks' assets values and financial performance. So the objectives of the study, the specific objectives include A, analyzing trends of banking sector performance and the severity of climate change in South Africa. B is through econometric analysis, examine the extent to which climate change influences bank performance in South Africa. And then the third objective is based on the results of the analysis, suggests policy implications for the study. And then the research question in my hypothesis, the main research question and the hypothesis is, what is the impact of climate change on banking sector performance in South Africa? So the hypothesis of the study, the now hypothesis is climate change does not significantly affect banking sector performance in South Africa. And then alternative hypothesis, the alternative hypothesis is climate change significantly affect banking sector performance in South Africa. So overall, I looked at the overview of the study and the South African climate profile and the banking sector snapshots. So the South African climate profile shows that more than 1.5 degrees Celsius temperature rise. There've been more than 1.5 degrees temperature rise since 1901, and rainfall is becoming more variable. And major droughts and storms have caused 3 billion rand annual damage. And 50% of surface water is consumed by agriculture. And water stress and heat impact financial asset quality indirectly. That was the South African climate profile. And then going to the banking sector snapshot from the study, 93% of the deposits are controlled by 4 major banks, which were part of my data collection for the bank performance proxies. And then impaired advances exceed 300 billion rand as of 2024. And then the high impact concentration increases systemic exposure to economic and climate shocks. And then lastly, the shift towards the digital and green banking underway. And then the literature review summary. The literature review summary have shown that floods have increased non-performing loans and reduced credit. And then the green human resource and environmental innovation affect profitability and risk. Temperature and precipitation affect sub-Saharan African bank stability. And then climate risk index affects South Africa banks' risk exposure. And the gap now of the study, there was a limited empirical work focused specifically on South Africa using long-term data. The conceptual framework, this conceptual framework is adapted from Zheng 2021 and illustrates how climate change impacts bank performance through different channels. So at the top, climate change, represented by changes in temperature and precipitation, can trigger now natural disasters and other physical events. So this leads to three main types of risk for the banks. Firstly, the fiscal risk, such as damage of property and infrastructure, credit risk, where borrowers now struggle to repay loans, and transition risk, which arise when policies and markets shift towards a low carbon economy. So these risks can now, they reduce key measures of bank performance like return on assets, return on equity, net interest margin, which are used in this study, which are often mediated by broader macroeconomic shocks such as gross domestic product and changes or inflation. So moving on to the methodology that was used for this study, the approach used the quantitative econometric modeling, which is the panel autoregressive distributed leg model. The time frame of the study was from 2003 to 2022. The sample was for 5 major banks in South Africa, which are the banks that are listed. And then the variables employed, my dependent variables were return on assets, return on equity, and net interest margin. And then the independent variables for climate, it was temperature at 2 meters and precipitation sum average. So the climate variables were structured from the National Aeronautics and Space Administration. And then for the macroeconomics variables, there's gross domestic product, consumer price index, unemployment, real effective exchange rate, and trade balance. Moving to the descriptive statistics and diagnostics. So the temperature at 2 meters and precipitation sum average show interbank and temporal variability. GDP and CPI show the effects of 2008 and 2020 macro shocks. The temperature at 2 meters trend shows rising temperatures, and the precipitation sum average have shown erratic rainfall patterns. So from the variables that I took for the study, when tested for stationarity, it shows that the variables are mixed. Some are integrated at level and some at the order of 1. So there was no co-integration. So that justifies the use of the dynamic panel autoregressive distributed leg model because it handles mixed integration orders, avoids spurious regression, and captures both short and long-term effects. And these were the results for after running the data, and then I'll interpret them on the next slide where I put the estimation results. So the autoregressive distributed label estimation results shows that temperature at 2 meters have a significant negative impact on return on assets and return on equity and net interest margin. The precipitation sum average is weaker but still negative relationship with bank returns. And then GDP shows that and real effective exchange rate improve profitability. CPI and unemployment negatively influence bank outcomes, and that also aligns with the studies that were done before. Interpretation of the findings. Climate change increases risk for banks by lowering asset quality. Higher temperatures and erratic precipitation affect borrowers' ability to repay, and banks exposed to agricultural real estate sectors are more vulnerable. GDP growth buffers banks from external shocks, and macroeconomic stability enhances resilience. And going to the conclusion and further research, the conclusion is climate change negatively impacts bank performance in South Africa. The temperature 2 meters and precipitation sum average are effective climate risk proxies, and the banking sector stability is threatened by physical and transition risks. Policy interventions are therefore essential for sector resilience, and future studies should now focus on the firm level impacts, alternative climate proxies, and longer term horizons. And then lastly, on the policy recommendations, there will be to encourage environmental and social governance reporting and green credit guidelines. The second one, policy recommendation, will be encourage climate risk disclosures by banks. The third will be to adopt green financing tools. And the last one will be the mandate climate risk stress test for systemic banks. Thank you for your attention. And